Today we've got a fascinating duel, the traditional heavyweight store of value, gold, versus the challenger, Bitcoin. We're going to unpack the ratio of Bitcoin to gold that has formed a massive 4-year ascending triangle, a formation that may deliver a structural verdict on which asset truly holds up as the future's safe haven. So, buckle up. By the end of this video, you'll understand what this triangle chart means, why this contest between Bitcoin and gold matters for your portfolio, what the possible scenarios are: breakout, breakdown, or consolidation, how you might position. So let's dive in. For centuries, gold has reigned supreme as a store of value. Central banks hold it, investors shelter in it during crisis, inflation hedge, etc. Its dominance seemed unshakable until Bitcoin arrived roughly 16 years ago. Bitcoin began as a niche experiment, but fast forward, it's now a trillion-dollar asset class and a serious contender. The debate between the two assets often revolves around contrasting themes: tangible, gold, versus intangible, Bitcoin, natural scarcity versus algorithmic scarcity, legacy system versus new monetary paradigm. So I reduced the debate to market evidence, namely the BTC/gold ratio. How many ounces of gold one Bitcoin can buy. That ratio for 14 years has trended higher and now shows a major technical pattern. We'll look at that next. Here's what the data shows. From around 2011 onwards, the BTC/gold ratio began climbing. Back then, one Bitcoin could buy only a tiny speck of gold. Over multiple cycles, 2013, 2017, 2020 to 21, the ratio surged, corrected, but crucially, the corrections didn't break the higher-low sequence. After the original steep primary trend line broke in 2018, a broader secondary trend line held up, meaning the structural uptrend remained intact despite volatility. Then, in the last 4 years, something interesting happened. Instead of continuing a steep upward move, the ratio entered a sideways compression, forming an ascending triangle, a horizontal ceiling, where the ratio keeps hitting resistance near approximately 35 ounces of gold per Bitcoin. A rising floor, higher lows as buyers defend dips more aggressively. This tension has created a textbook ascending triangle. Why does that matter? Because such a pattern typically foreshadows a big move once the consolidation ends. Now, it's not just about chart geometry. The triangle is essentially a visual representation of the broader store of value battle between Bitcoin and gold. If the ratio breaks out, Bitcoin beats the resistance and goes much higher relative to gold, that signals the market endorses Bitcoin as the dominant store of value and, by extension, maybe the future of money. If the ratio breaks down, that is, loses the rising trend line support, that signals gold is reasserting itself as the true safe haven asset, and Bitcoin's run may be just growth/speculation rather than store of value. So, this triangle is not just a chart pattern. It's a verdict pending between old money and new money. And for investors/portfolio managers, the outcome has serious ramifications. Whether to weight gold heavier, Bitcoin heavier, or hold both. Because whichever side wins may attract major flows. Institutional adoption. Let's zoom out and look at the underlying drivers for both gold and Bitcoin. Gold's driver set: central banks accumulating gold, recognition of its safe haven physics, geopolitical stress, inflation concerns, multipolar monetary system risk. Gold tends to benefit regulated, tangible asset with no dependence on digital infrastructure. Bitcoin's driver set: adoption rising, ETFs, institutional capital, on-chain metrics improving, scarcity, 21 million cap, decentralization, appeal to younger generations, might benefit more from risk on liquidity, dollar weakness, and tech innovation than gold. This dynamic means the ratio's move will reflect not only which asset is better, but which macro regime is prevailing? Safe haven gold versus innovation slash forward looking Bitcoin. All right, let's get into the scenarios and what each would imply for your portfolio. Scenario A, breakout Bitcoin dominance. If the ratio breaks above the 35-ounce resistance and moves decisively higher, I estimate a potential target of Vodker's 51 ounces of gold per Bitcoin based on previous triangle breakouts. Implication: Bitcoin becomes digital gold. Institutional flows accelerate. Narrative shift. This would validate heavy allocation to Bitcoin or crypto broadly for store of value / hedge roles. Scenario B, breakdown, gold resurgence. If ratio breaks below the rising trend line and possibly the 52-week simple moving average and falls back toward the 22 to 23 ounce range. Implication: narrative flips back to gold as a safe haven. Bitcoin becomes more growth risk asset than core hedge. Portfolios may shift into gold, diversify away from crypto. Scenario C, continued consolidation stalemate. The ratio stays inside the triangle, neither side taking full control. The article points out it's already been stuck 4 years in this pattern. Implication: no decisive verdict, might favor diversification, holding both assets rather than making big bets. For investors, patience and balance exposure. The key message: until one of those directional moves happens, we remain in limbo. And that itself is actionable info. Let's summarize what we've learned. For over a decade, the BTC/gold ratio has told a pretty clear story. Bitcoin outperforming gold as a store of value. But now we've reached a climactic point. The ratio is compressed in a 4-year ascending triangle, signaling that the market is sitting on a verdict. If Bitcoin breaks out, it becomes digital gold. If gold takes back control, Bitcoin becomes a growth / risk asset, not the new safe haven. If neither happens, we stay in neutral, and diversification is a smart path. So here's my verdict. I'm cautiously bullish on Bitcoin long term, given adoption trends and technology, but I'm not ignoring gold. There's still an established case for it under certain macro regimes. For many investors, a balanced approach with both assets makes sense while we wait for the triangle to resolve. If you're new to Bitcoin, don't go all in. Consider staggering your exposure, set clear risk thresholds, and treat any position as part of a broader portfolio. And for gold, think of it as the insurance piece. Low yield, but high optionality during crisis. All right, if you found this breakdown useful, hit the like button, subscribe if you haven't yet, and comment below. Which side are you leaning? Team Bitcoin or Team Gold? And why? Thanks for watching. Stay wise, stay diversified. I'll see you in the next